Hello and welcome to this edition of Closing Trades, and it's turning out to be a bloodbath Monday on account of the weak handover from the globe. Things have only gotten from bad to worse now. We're at the session lows and a major chunk of the selling has been very, very gradual. At no point other than that gap down have you seen a big nose down of sorts. It's been a very, very gradual and a very grinding fall for the market that we have seen, and it's pretty much a mirror image across indexes. It's not just for the Nifty alone, but even a Nifty bank. The broader markets, of course, have succumbed to even more selling pressure. We're now headed in for an 850 point decline for the small cap index alone, 361 points gone for the Nifty already. And it's a dismal market breadth within the F&O universe. There are only 9 names which are standing to the green, and none of them any significant movers other than perhaps AB Capital, which is also less than 1.5% higher. It's a good 191 count that you have to the declines for yourselves. In fact, look at the way the mid and the small cap indexes are actually falling. Let's bring up those intraday graphs because that's where you are seeing excruciating pain. The Nifty mid cap 100. And that really is a telltale sign. That itself is now headed in for a 1,000-point decline, 800 points gone for the Nifty small cap 100 as well. And that really explains the kind of bloodbath that you're seeing on the markets. Be it the Adani names, be it blue chips like a Trent, which are down 6%, BEL, which is down 4.5%. There's a Tata Steel, which has cracked 3.5%. Some of the technology names are coming in under heavy, other than perhaps TCS, which is seeing some bit of follow through from Friday. ONGC down almost 3%. There's the Hero Motorcorp, Tata Motors, L&T, Reliance, ICICI Bank, HDFC Bank. I don't think anything out there is really spared. It's senseless really talking about any stock-specific movers or newsmakers rather. That's pretty much the state of the market. There's only Axis Bank alone, along with TCS, which is somewhat managing to latch on to the green. And even those names, by the way, IndusInd Bank, when we came into trade in the first 1 hour, was I think holding up about 2% or so in the green. That too has come off quite significantly and barely latching onto the green as we speak right now. Just very quickly for the broader, or rather the global markets as well, because it pretty much seems like a global meltdown. It's been a 400-point decline for the Japan as for the Japanese index as well. Hong Kong too lost about 200 points. Shanghai was also a little bit soft, and that's pretty much the state across the European screen as well. You are seeing cuts of 0.5% to 1% pretty much across the board, and the pre-market rates for the US as well are indicating some more of a sell-off, and this is in addition to the Friday sell-off that you had. It's another 200 point on the Nasdaq futures of a decline, 150 point thereabouts for the Dow already, and 0.6% loss for the S&P futures as well. Kunal, hi afternoon. Though nothing really good about this afternoon. What's the screen telling you? Is the selling going to abate anytime soon? Because this is almost like a free fall, and a very grinding one at that.
Yeah, free fall. 4,000 points shaved off on the bank in the last 7 days. 1,200 points on the Nifty in the last 6 to 7 trading sessions. And this is just a start, because when you look at this in terms of the individual stocks and the way many of these stocks have corrected, I think the intensity is pretty much on the higher side. Now in these kind of free fall scenarios, it's very difficult to anticipate where the index would hold on in terms of support levels, because generally the strong psychological marks for indices, for example in this case 23,000, we generally believe that they act as strong support territory, but that happens in a very normal market scenario. In these kind of an extreme market scenario, we expect that the index doesn't hold on to these strong psychological levels, and it gives away. So it's really the intensity of the sell-off which is happening across the stocks, which could probably try and indicate that when and where will this correction end for the indices. But this looks like a very grim situation for the index. We've been making consistent pattern of lower highs and lower lows. There was an intraday recovery, I think even for example today, where the index tried to come back into some bit of positive territory. There was an intraday recovery, but that was sold into in just minutes. So that itself tells you that the strength of the bears is much more overpowering as compared to the feeble comeback in bulls.
All right, so kind of a sell-off where the end is not something that is, the picture is really not clear to that. But Kunal, do you believe that it is one of those days where investors and rather traders are just waiting for the day to actually end and the markets to shut shop?
Yeah, that generally is the case because in negative market scenario, you would probably want that the index, of course, ends on a pretty much tepid note. But I think one word of caution for everyone, I think, has to be that leverage has to be cut down in terms of portfolio. So if not, the markets have done it already in the last 6-7 days. I think rather than taking extreme amount of position over here, one has to look out for adhering towards risk parameters and risk disciplines very, very strongly in these kind of market scenarios.
All right, that's the technical say coming in on the markets, but definitely, what do you call it, a black Monday, Monday mayhem whatsoever, but it's been a sharp knockoff on the markets right now. So let's connect with more of our experts. Then Deepak Shenoy is also joining us on the show. Deepak, help us with your take on the markets, because given that we were just having mixed cues when it comes to the macro data and we were heading lower, but given that today's fall, is it also surprising for you? Because even the large cap names are falling anywhere between 4 to 5%. So how scary is this fall for you, or you believe that this correction was anywhere warranted?
To some extent, I think it gives you the reiteration that stocks are volatile. Stocks have not been volatile for the last 2 or 3 years. I think to that extent, we're seeing that volatility come back. Big sharp down days like this are relatively good in the longer term for markets, because when you get these the capitulation, the forced selling, if you may, sometimes, or the selling because there's extreme leverage or anything like that happens. We don't know what's actually happened. Of course, nothing really has changed fundamentally, but I think, are seeing a lot of expectations or a fear of the uncertainty that a US presidential change, which will happen next week, will bring along, and so on. I think this is one of those times when a lot of market activity is on. I believe that this volatility is good for us. It's already brought in a lot of stocks that perhaps come down into buying ranges. Even the blue chips are not safe. Markets like this are not. You cannot say that, oh, my stock fell only 4% when your stock fell 6%. That doesn't give a lot of solace to investors. But I think you should look at it at a longer term. If you're getting such corrections, there will always be stocks that sell off for more than they should actually. They become even more value at some point, and therefore those opportunities give you something to look forward to for a next 3 or 4 year kind of investment. I think it's a good time to start looking more seriously at stocks which you thought were expensive in the past and maybe now have come into your buying ranges.
So, Deepak, quite curious to know what's the shopping list looking like for you?
I'm still actually quite bullish, Aisha, on defense, on infrastructure, Indian infrastructure, on the financialization tools. So whether it is companies in the financial market spaces providing services directly to customers or providing services to brokers and intermediaries, I think those continue to be in our radar. We're also interested in domestic consumption. The consumption plays have relatively been more expensive. I'm not talking about FMCG, but I'm talking about more branded consumption, if you may, or higher end consumption, not biscuits and the like. But also, I feel that the import substitution, energy independence kind of theory will start to play out in the next few years. You're going to get a lot more companies manufacturing in India. So the manufacturing companies which have fallen, I think many of them are in very reasonable ranges now. So we should, we've been starting to buy more in the last few days. So corrections like this are always a little welcome in that sense.
Sure is. So let's pick up on the themes that you just talked about, Deepak, because you said defense as well as manufacturing. Manufacturing, the large umbrella that it is, where exactly are you finding value now?
So there are some companies which are auto ancillaries, because that is one of the largest things where we have a really good top to bottom kind of supply chain in the manufacturing part of the industry. Defense is relatively new, so a lot of manufacturing companies in the auto space or providing services to the auto space are actually diversifying into defense. But there's pure play defense companies as well, whether it's data analysis companies or small equipment manufacturers and so on. There is actually, I think the government has not really spent a lot of the money that it was supposed to this year. And perhaps that money will get spent in the next few months or in the next financial year. Either ways, the orders should start to flow into these companies. And the scope is where, they can grow 5x and 10x in the next decade, rather than the relatively small growth that you'll see in the, say, banks or some of the IT service companies. I mean, the growth there is there, but it's much smaller. So I think the manufacturing plays here, and even people who are making tools that help other companies set up manufacturing plants that are providing B2B kind of products are also on our radar. A lot of these are relatively small companies, so the kind of scale that they can see if they were just to get 2x or 3x their businesses, the economic leverage that they can see is quite substantial. Our companies have very less leverage, for the most part, other than the NBFCs. So we don't have a debt crisis. And you don't have the issue that companies will go insolvent. All corrections are opportunities, because a company that has a solid balance sheet has the ability to leverage itself to recover much faster from a downturn. But it's not an economic downturn, it's just a market downturn, and I think that's fine.
Quite interesting to note that you are finding value in some of these auto anchors names, but can we be more specific here? Any name that you can help us with that is on your radar where you are finding value at this point?
So, I mean, of course, we end up buying these companies, so I'm not necessarily unbiased here. But I'll shy away from stocks where actually, starting to pick up, because it doesn't serve us well. But look at the top, even in a company like M&M, though it now has plays in defense as well. It has plays in IT services. It also has the large auto manufacturing area. I think there is a lot of scope for this as a group, not just as an auto company, and therefore I still find it reasonably valuable from that perspective for longer term. So I'm blocking 5 or 10 years. That they will do considerably better than they are right now. There are a few other companies. I won't take too many names right now. Some of them are smaller caps. They're scary because you'll find them fall 8 or 9% in one day and go up 8 or 9% the other day. But I think companies in this space will find the opportunity, and they're not necessarily only auto ancillaries. They will be companies that supply to the manufacturing chain, companies manufacturing in the auto anch space, maybe the pistons or gears and so on, or companies in the engineering space. And one of the names I can give you is Alicon, for instance, which we owned for a while. And it had gotten to a point where it was a little expensive, and now we find it much more affordable for the long term. They have a little bit of defense as well, but they also have traditional manufacturing. They've supplied to other manufacturers. So I think companies like this will be is where my interest is, at least for now.
On engineering, that's the stock that Deepak just highlighted. If we can just bring that up. Deepak, hold on to that thought. A lot of interesting takeaways that you've given us today. But I think the other thing which is crashing with equities is also the currency. The fact that we're already higher than that 86 to the dollar level already. That also has a huge amount of bearing on the way equities, I guess, across emerging markets are also panning out. 86.50 now, actually. So that's a fresh record low. I'm going to quickly take it across to Nikunj as well and help him analyze the market fall today.
So, Aisha, it is nothing short of a perfect storm, and a lot of things actually have aligned against us. If one really looks at the global setup, it is a combination of dollar index, rising yields, and the fact that flows are moving out of not India but emerging markets, including China. So what was supposed to be a consensus trade that money will come back to emerging markets come 2025, that has not translated into reality, which in a sense is having an impact at the global level. So that's the global setup for you, where just about every emerging market has started correcting. Some of the popular markets like India, that's where the gains are the highest in last couple of years. So I guess they are the ones who have fallen the fastest. Now, how long will this interplay where everybody is hiding into the dollar, or this excitement ahead of Donald Trump, Donald Trump inauguration? How long will this last? That's anyone's guess. But my sense is that this is becoming more like a crowded trade, and crowded trade, they seldom last beyond a point. So I'm not saying we are at a point of climax in the global market, but the risk reward ratio now to perhaps buy anything which is largely dollar denominated at these levels clearly cannot be made. So on global level, while the screen is not looking all that exciting, you need to start thinking that how long will this weak dollar interplay will continue. Second is rupee. Completely contrary to what everybody was anticipating and expecting. Rates were supposed to come down globally. Rates were supposed to come down in India. India's core fundamental, which, for rupee to deteriorate, it's a combination of macro and micro. The micro has been slowing down and the macro has been stable, considering where the fiscal deficit is, where the high frequency data point is. But the fact that flows are gravitating out of India, Reserve Bank of India's forex reserve has used the forex reserve, that is not helping the currency either. But the problem, Aisha, today for the market is not global or currency. I think it is a breadth of the market where mid and small cap stocks are really on the butcher block. And that's where I guess the problem has come in. We must bear in mind that while we may look at today's fall in isolation, or we can add back last week's volatility and say that, okay, this looks like a very it is a scary number to look at when you look at the magnitude of the fall. But this is something which I think markets have periodically told us. The same PSU stocks which had no sellers today are finding no takers. On an average, the decline in PSU stock is more than 35% for these stocks which have appreciated or which had appreciated by 3 to 4 times. So excesses in the market, I think, they're getting out. The HNI and the ultra HNI community, which in a sense was in a mood to only buy and buy and buy and never sell, suddenly is selling without thinking. So there is, I won't use the word panic, but there is definitely a lack of participation which is making the markets look hollow, and markets today are falling on low volumes. Now, where do we go from here, Aisha? I think that is the most important thing. And I think there is no easy answer. I can stick my neck out and say that last 3 years, we've had a setup of low volatility and high returns. I think we're entering into a setup of high volatility and low returns. To make a case that, okay, we are nearing any kind of a bottom, it would be very early. However, to make a case that, the bull market is all over, I think that's foolish. What you need to do in this market, Aisha, is that ask yourself that why you own that stock and what is your time frame. If you keep your return expectations low, extend your time frame, and if you know what you bought, I think you'll survive this. But if you own something which is in leverage, if you don't know why have you bought it, and if expectations are that, oh, you bought the stock and you'll make 50% return in next 6 months, I think that's a silly and foolish kind of return expectations. So what will save you in this market is your identification of the stock, your ability to hold it for next couple of quarters or maybe a couple of years, and then keep your return expectations low and understand the business which you own. If you put these filters, I think this would be a passing correction. It's not for the first time in this bull market also, Aisha, we've seen this correction. 2022, we saw this kind of a correction. Before Ukraine and Russia crisis, after the crisis, we saw this kind of a correction. We've seen this correction, I think, same time in March or April also, where the mid and small cap stocks, they came and they really got chopped. So it's not that it is game over for the bulls, but yeah, there is definitely a lack of momentum. There is lack of participation. There is no real compulsion for anyone to buy, and that is the ugly part of the market. When the going is good, you get blinded because of the momentum, and when the going gets bad, I think you get blinded by what the opportunity is. So that's my limited point here, that if you don't know what you own, I think it's a bad time to own those stocks. Increase your risk horizon and then keep your return expectations low. Jayesh Mehta also joins us. Jayesh, nice to have you back on ET Now. Thank you for joining us. Jayesh, what's happening to the rupee? Can we only blame it on the dollar?
I think you summarized it pretty well, right? So it's all about everybody wants to sell all other currency, all other markets, and invest in US. I think there was an expectation come January, come 25, we'll have fresh allocation coming to EM. But sorry, that didn't happen. And that momentum for US only. And that is continuing. And I think for us, as you said, macros are still good. But on a micro, I'll also touch upon FPI selling is also dollar outflow, right? So we don't have that much of depth in the market. If we have daily outflow of 300 to $500 million for FPI withdrawing that money, that will be, of course, in a global dollar strengthening market. You will also have traders coming in to take along with that side. So all that put together at this juncture, it's not only us, other currencies are also impacted, but we are impacted more because we kind of remain very tight when the initial outflow happened in August, September, October. So kind of at that particular period, we were, rock solid while others were depreciating. So I think we had to have that catch-up game, which has happened. And as you said correctly, we don't know when it will change. It's a question right now. The consensus trade is to basically every other market bad. It's only US market. I think at some point of time it will change, and that's when we might start seeing at least, if not new inflows, but at least the exits once they start stop. That's where the currency will stabilize. But till that time, I think it will continue, and I don't know how long, right? And there's nothing right now in this global environment you can take a major drastic step as an independent country. So from that perspective, it's quite challenging. We'll have to wait for how the US strength kind of goes through. But as you said, till the election, maybe momentum following after that. So we will have this pain at least for another 20 days or so. And then we don't know. It's a hope trade that, okay, maybe the world will kind of realize that it's not only the US market, other emerging markets are also worth investing, but it's just a hope as of this juncture.
Yeah, seems to be the case. But Jayesh, that's exactly the point that I wanted to talk about. Do you not think that the RBI will intervene at this level, or can they even do anything to try and arrest the fall of the rupee?
So even if they intervene, right, that would be a temporary blip, because you see right now the move towards US dollar strengthening, right, and you see in our normal flat market, what happens is only the outflow which materialize, right? So if an FPI sold say $500 million, so that's the money which is going out. But when you have a momentum going with US strength, and when you see that there is an outflow in India, there are other traders globally in the NDF markets and others. They will also play with the momentum, right? So it then for a central bank to control that kind of momentum becomes difficult. But yeah, if it is just to manage a 500 million or $1 billion or a couple of $1 billion outflow, that can be managed. But how do you manage the sentiments where, it's all about dollar strengthening? So that's where the momentum is right now. Till we see some momentum change there, or unless we see a drastic fall and then, intervene big time by RBI and bring it down dramatically. So that does hurt people, but these are all temporary measures, right? So the reality is, as long as we have equity outflow happening, which is a dollar outflow from the country, we'll have to wait and watch how it falls further.
All right, so we need to wait and watch at this point in time. But with this, Mr. Mehta, we'll let you go on that. Thank you so much for taking the time out and speaking with us. So definitely fresh record lows coming in for the rupee. That is something that we are waiting by to see as well. But given the markets, is some hopes on the recovery. It's some mild recovery that we are seeing from the day's lowest point for Nifty as well as Bank Nifty. But no major change in some of the gainers when it comes to the Nifty 50 movers at this point in time. But with this, viewers, we'll just slip into a very short break. Don't go anywhere. We'll be right back and take the market discussion forward with all of our experts. Welcome back to the closing trades, and we do have two of our guests as well onto the show. We have been joined by Vinay Rajani as well as Deepak is also with us. And Deepak, I just wanted to have a sense on all these large cap and especially the OMCs, the fall in the OMCs that we are seeing at this point in time. Definitely the crude is on the boil, but there were some hopes that given the earnings season, there could be some respite coming in on the BPCL as well as HPCL numbers. So Deepak, help us with your understanding on the OMC basket at this point in time, and how are you placing your bets within the oil and gas space?
So we have Reliance, so I'm biased a little bit on that side. But I think the HPCL, BPCL like the combine, is actually stressed right now, I think, because of the crude price, both in the dollar rise compared to the rupee and effectively crude price increases. But I think this is relatively shorter term or shorter lived because the US is likely to become a fairly large exporter of crude oil. So we are likely to see prices stabilize across the board once Trump comes in, because I think they're pushing for a lot more of the fossil fuel based energy generation anyways across the board. I think that is going to be that's going to be beneficial for India in the longer term. However, right now you're going to see this fall happening regardless of fundamentals. I think a lot of it is just liquidity driven, and therefore even though these companies like HPCL, BPCL are relatively fairly valued and have been even before this, I don't think they're going to see any kind of a respite just because they announce a dividend or something like that meaningfully. At some level, they will suffer from the liquidity going out, and therefore their stocks also suffering. So I think they're interesting plays. They're not very good growth stories. They're mostly dividend plays for it, and we have not even seen those dividends happen in the last year or so to a meaningful fashion. So let's hope that the results when they come this time will show something positive. But we don't have any positions here. I have a position in Reliance, but that's not related to oil and gas. It's more related to their geo and retail arms and the potential demergers in the longer term.
So did you add any more to Reliance, Deepak, at 1200 thereabouts?
Yes, we've been adding to it for a while. I mean, it's a broken record. I've been saying this for a long time, but I think I'm still on the wait and watch mode. We're building positions even now. Not afraid to say that it's been a long wait, but I don't think this company is going. It has a lot of levers for it to benefit from India's growth. And if one or two of those levers really work, you can see a much bigger economic result for this company.
Yeah, you've been patient with Reliance for quite some time, and it is one of those stocks, right, which tests your patience for many, many years as well. But Deepak, earlier you were talking about consumption X staples, of course. What within consumption is looking attractive right now? Would you play it via realty? Would it be via autos? Would it be via retail? Hospitality, aviation? Because consumption, again, is a very large umbrella.
So two areas here, Aisha. I think hospitality / tourism is one of our longer term focus areas, because I think India is just getting to a point where people are eager to travel. We don't have enough avenues. I'm sure there's just so many things that form parts of our tourism, and whether it is religious or whether it is just leisure, the venues are there, but the hospitality options are limited. So I think there's a large scope for growth in these areas. We're seeing large ticket fares both on airlines and even on the train occupancy rates and so on. I think there's a lot more that will happen in that front. There's also auto. I think auto has been lagging for about 4 or 5 years in terms of the pickup for new cars. We haven't seen that happen for a while. Something was moving forward in two-wheelers, but even that has kind of slowed down. But I think longer term, we will kind of come back and we will see a significant growth in both two-wheeler and four-wheeler passenger vehicles. I think that part continues to be one of our driving forces, but also interesting long-term brands as well, whether they are some of them, some part of healthcare is also, unfortunately or fortunately, a consumption issue now, because a lot of discretionary kind of usage of hospitals happens. It's not just emergency. So there is a part of that also forms, into the consumption phase, including diagnostics, including hospitals and so on. So I think these are areas where I think India is going to see a lot more. There is, of course, brands. We haven't seen that many brands come out of India meaningfully, but you're seeing a Bikaji start to list. You might see some of the other brands start to list. Those are all interesting brands. They've been very expensive. hopefully now we get a chance to enter as well.
All right, Deepak, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us, and also help us understand and spot some of the themes that are looking attractive at this point. But getting back to the crude oil then, because government sources allay concerns over the crude supply, say that the extra sanctions on Russian oil will not deter India in any way. Let's go across to Prakash for more details on this one. Take it away, Prakash.
Yes, our sources in the War Ministry are saying that it's not going to impact India, as there's ample supply in the market, and India has already diversified its import basket over the years. In fact, we are now importing from 39 locations, which was 26 earlier. So there is ample supply in the market, and the government's officials are not seeing any such knee-jerk reaction, and therefore they are very confident and saying that any fresh sanction on Russian oil is something which is not much worry for the Indian market, for the India, as we can meet our requirement from different sources if there is any shortfall in the market. Along with that, the sources are also confirming that yes, if there is something which needs to be taken care of and is something which is a worry for the crude market, is of course logistic cost, because there's a possibility that there may be some disruption on the routes, and that can be something which is a worry. But at this point of time, it is not going to impact India to the large extent, and of course the Indian refiners are very confident. In fact, they have long-term contracts and they are getting sufficient oil from different sources. So at this point of time, there is no much worry for the Indian companies.
All right, Prakash, thank you so much for getting us all those details. Fresh sanctions on Russia by the US, and Oil Secretary of India does say that no impact on Indian supply, rather, at this point in time is what they are foreseeing. But with this, let's move on, and let's also welcome on board Rajat Sharma, founder and CEO of Sana Securities, as well as Vinay Rajani is also with us. A very good afternoon, gentlemen, and thank you so much for your time. Rajat, firstly, help us with your take on some of the recent darlings of the market. If I could give us some names, stocks like Paytm, where brokerages upgrades were seen coming in. Zomato had that quick commerce story playing in, and even stocks like PB Fintech as well as Dixon Tech were doing well. But given the market sell-off, see the sort of a correction that we are seeing, they have corrected anywhere between 15 to 20% from their recent highs. So Rajat, any of these stocks that look attractive to you at this point in time, because feels like they are available at good bargains?
Good afternoon. So out of the three stocks you named, to be honest, I don't like any of these, and I didn't like these even when they were available 30-40% below where they are right now, because I think for PB Fintech and a lot of these other Paytm, there's obviously a lot of competition within that space. Paytm, I did say around 400 odd levels that this could be a prime takeover target by one of the companies, which may be the only reason why you should have bought this, which may be the only reason why people are buying this, because nothing has changed fundamentally since RBI banned their payments banks since then. So I don't know why the stock has moved up from about 400, 450 odd levels to like 900 or so. The only two stocks in this new age tech business which I like, one is Nykaa, because they have their own product, so it's no longer just an online retailer. So that's a stock where I feel, if prices fall to about 120, 130 odd levels, this could be a good stock to buy and hold for a long term. As a disclaimer, I don't have this in my portfolio. Zomato, I keep hearing that, the story is that you're paying extra to have the same food at home, which you could get cheaper at the restaurant because you don't want to go out, and you save up on the cost of traveling and you can have it at the comfort of your home. But the difference between the earnings and the stock price, the valuations, if you were to, how much could the earnings improve for this valuation to be justified? It may be a good business, viable business, especially with Blinkit, quick commerce and food delivery. But it has to dig gold somewhere to match up to the valuations at which it's trading. So right now, not looking to add any of these new age stocks in my portfolio.
Interesting to know that you didn't like any of these stocks, rather, because those were some of the stocks that most of our investors were actually discussing on the channel. But Rajat, if not these, then what are you looking at this point in time? Any of the stocks or sectors that look attractive and which may be available at a cheaper rate today?
Yeah, no, so, very, very boring sectors and stocks, which I like right now, the traditional consumption businesses. I think Aisha was asking a question about specifics within consumption. And, within consumption, I like the FMCG space the most, the really core of consumption, the likes of Nestle, Britannia, Hindustan Unilever, ITC, because personally, my view is that this budget, there would be higher exemption on incomes. This budget would be all about driving consumption, both rural and urban, and the small ticket, things that you can get for 100, 200, 300 rupees. Basically, that's where earnings per will come. And that's also the segment of consumption, which is, I think, available really cheap. So if you see, FMCG stocks have not done anything in the last 3-4 years, because that's where consumption has hit the most because of higher GST or whatever may be the reason, but these stocks have gone nowhere. And, last time I was in a show, I said a stock like Asian Paints, which used to command a multiple of about 100 plus, and that was a darling of the market. And today it's available at a price to earnings multiple of 48. Nobody wants to buy it. And these are the stocks to look at right now as the cycle revives. A lot more money will come here. Looking at client portfolios every day, where I see a lot of clients complain that, markets are falling and our portfolios are falling a lot more than the markets, is because they've not made this reject. They've not moved out of, PSUs and defense, and they've not moved into these consumption themes and stuff. So I think consumption definitely is one space, and the other being IT, which is where we're buying more stocks. Mostly it's about buying more of what we already have. I said it 2 weeks, 3 weeks back before TCS came out with its numbers, and I think this trend will continue with a stronger dollar. A lot of these IT companies will keep posting very good revenue. 95% revenue is, overseas. So IT and consumption are two spaces, and the stocks that I spoke about, Infosys, ITC, HUL, Britannia, Nestle, that's where we're doing our buying.
And IT is the place to be, and we also got to hear some of the stocks. But whenever we understand that you are also here with us, but do allow us some time, because for now it's time to slip into a very short break. Don't go anywhere. We'll be right back.
Back with closing trades, and it's a carnage out there. I mean, whichever way you want to describe, there's really no hiding place. There's Axis, TCS, IndusInd Bank, but that's just a smidge of a green. AB Capital, though, is one name which is decisively holding out, and BSE as well. Vidya Rajani as well still with us. Vidya, I want to come to you on some of these capital market players, right? I mean, CDSL, Angel One, 361 RAM, BSC, AB Capital. You think this is while it's established, it's a structural trend, but are these stocks looking good for a buy? Any of these, either an AB Capital or a BSE, one of the top movers today?
So the trend is clearly down. So none of the stocks are looking good on the chart. So we have to, in technicals, we are following the trend and don't anticipate the bottom. Right now, the sentiments are quite weak, and small cap and mid cap, these stocks are falling like anything. So definitely this is not going to be a good thing for the capital market theme. So this thing can go negative for sentiment wise as well. And the technicals are also suggesting that small cap still have the potential to extend the fall. So better not to look for any small cap, mid cap stocks out of this capital market. Though it can be good for the long term, but for technicals, at least they are suggesting the weakness in the short term. And better not to anticipate bottom and stay with the trend. So right now, I don't think one should take any long trade for the short term in the capital market theme.
Okay, that's really the take coming in on some of these capital market players. But Rajat, we've often talked about some of the private banks in the past. In this recent correction, do you think they'll once again emerge winners whenever the market does resurrect?
Yes, Aisha, I have no doubt on that. And I think some of the private banks, the larger ones, especially HDFC Bank, which is one of my favorites right now, they have to do well because you have these banks available at such cheap valuations right now that whenever the cycle turns, a lot more money will come back into these banks. Make also no mistake, and remember HDFC being the highest in terms of weightage on the Nifty. The problem we are facing right now, one of the biggest problems is FII outflows. Whenever FIIs come back, which sooner or later they will, this is private banks like ICICI, HDFC in particular are favorites of these guys. And then, from multiples of 28 now it's trading at multiples of 18, and that's the number one thing I look at. So, financials and within that private banking is something I really like at this time.
Okay, let's take some BTST ideas as well on that note. Kunal, what's on your list?
So I'll go with two shorting opportunities. The first one is a sell on Indian hotels, with a shorter term target of 735. Stop loss could be kept at 785. Expecting that this correction would just about continue for a day more for the stock. And the second was a sell on PEL, something which I've been recommending over the last few days. So extending the price targets on the downside to 920. Stop loss could be till to 970.
All right, even today morning you were having a sell on Piramal Enterprise on an intraday basis. It's a 4% cut, but still would like to go with that STBT idea. But winner, what's on your list? Any of your STBT or BTST ideas?
Yeah, so obviously I would like to go short. So because market is trending lower, and the stock like Dixon, which has broken below the crucial support. So Dixon is looking weak. So right now it is trading around 15,900. I think 16,200 should be kept as a stop loss in the spot, and I'm expecting a lower level of 15,350 to 15,400. So this can be a short idea for STBT for covering tomorrow.
All right, Dixon Tech is a shorting idea at this point in time to cover tomorrow morning. So definitely both of our experts are going with the sell trades right now. But amidst this, we do have also the dollar index that is seen to be hitting level of 110, and that's the spike that we have been discussing. The dollar is getting strong, and there's indeed some pressure that is coming in on the emerging market currencies, and rupee is definitely one of those. But in today's fall, some of these IT majors are also seen to be falling very sharply. And Kolan, if we can quickly have your take coming in on Coforge, because this was one of the stocks wherein recently as well we have seen a lot of these brokerage upgrades coming in, and today a 7% cut coming in on this counter. How do you see this?
So I would still believe that Coforge is one of the strongest names from the mid cap IT stocks. Now there comes a phase in the market where the strongest stock eventually they would also start getting into some selling pressure, because then the law of mean reversion plays out into these stocks eventually, and there's mark to market adjustment selling which happens into individual portfolios. So I think on the back of this is where you expect these stocks to get back into a stage of underperformance or maybe some sort of a mean reversion. But then these stocks more or less they manage to hold on to their nature of being class outperformers from the respective sectors. So I think this space I would believe Coforge could continue to remain as a key outperformer. Yes, short term wise there could be a bit of additional days of selling pressure, but once the market revives or gets back into any kind of a bounce back, Coforge would be amongst the first ones to indicate a very strong kind of a bounce.
Okay, that's that on Coforge, but look at the carnage that's played out in some of these frontline names. Look at a trend that's fallen about 5.5%, a little bit of a recovery somewhat. BEL down 4.25%. There's been a Tata Motors which has taken a knock of about 3%, 754 thereabouts on the futures for this stock. There's been M&M which has fallen about 3%. ONGC we've been flagging off from the word go today. And I also want to see what's happening within the broader end of the market. Look at Lodha. That's down almost 9%. Of course, it's an F&O stock. A Policy Bazaar has cracked about almost 9.25% as well. There's been Adani Green, which has taken a knock of about 9%. Relentless selling in Kalyan Jewelers in specific, another 8% of a fall today as well. Paytm is down about almost 7.5% today. And I want to check in on where DMart is closing the day after those earnings, which were a miss on all counts. And of course, that management change as well. A 5% cut is where DMart as well closes the day, with Avenue Supermarts at 3,500 thereabouts. Other than that, of course, like we've been pointing out, the carnage across sectors, the carnage across individual names from within the broader market has been quite significant. Naukri fell off about almost 7.5%. Zomato also has cracked, by the way, a good 6.5%. 228 is where Zomato is, and I think these are levels we've not seen on Zomato in a very, very long time. Supreme Industries, SVGN, there's been Adani Enterprises, Indian Hotels, which has cracked about almost 6%. 759 is where that stock shuts shop for the day. DLF has cracked about almost 6%. Oberoi Realty, I think sectorally, other than banks, because of their weightage and some of the specific IT names, it's really been Realty which has really taken it on the chin, be it an Oberoi Realty, DLF, or for that matter, Lodha, which has been your biggest laggard from within the real estate sector. Shrishti, what are you spotting?
I'm actually looking at some of these names that were actually successful in holding on to the shade of green. Aditya Birla Capital is ending the day with 1% gain after that Morgan Stanley upgrade. A good day coming in for Biocon after the Malaysia facility USFD approval. MSCI inflows in the FI holdings is actually quite less in IndusInd Bank, and Nuvama believes that this could be one of the key additions, and some inflows can be seen in IndusInd Bank. HCL Tech is also one of the stocks that we have been tracking. Results awaited, is also shutting shop with almost flattish sort of a gain. Reliance Industries actually did support the markets, would say, because that's ending the day on a flat footing, no significant pressure coming in from Reliance Industries rather, but HDFC Bank, a cut of over % did weigh heavy on the Nifty Bank Index. Sectorally, definitely, yes, it's Nifty Media actually that is down about 4%, followed by Nifty PSC Basket, Metal, Energy, PSU Bank. These are some of the sectors that have fallen over 3% in today's trading session.
Okay, and with that, we're going to wind it up right here at this edition of Closing Trades. We'll see you again with all the market action tomorrow morning at 8 a.m.